You've watched the videos, you understand what ETFs are, you know about compound interest, you've got your investment plan. But now you're sitting at your computer, staring at a brokerage website, and suddenly everything feels complicated. Which broker do I use? How do I open an account? What does market order mean? What if I press the wrong button and lose money? I hear this from so many people. They understand investing in theory, but feel paralyzed when it comes to actually doing it. Today, we fix that. I'm walking you through every single step of buying your first ETF, from choosing your broker to placing your very first order, so clearly that by the end of this video, you'll be able to do it in under 30 minutes. By the end of this video, you'll have completed 7 simple steps to own your very first ETF. Step 1. Choose your broker. Step 2. Open your account. Step 3. Fund your account. Step 4. Choose your ETF. Step 5. Place your first order. Step 6. Set up automatic investing. Step 7. Turn on DRIP. The entire process takes under 30 minutes. I'm going to walk through every detail so nothing surprises you. Let's start. Quick disclaimer. Everything I share is purely educational based on my 10+ years of personal investing experience. I am not a licensed financial advisor, and this is not financial advice. Brokerage platforms update their interfaces regularly, so the exact steps may differ slightly from what I show. The guidance here is general and educational. Always verify the current process with your chosen broker's support team. With that said, let's walk through your first ETF purchase. Before we get into the steps, let me briefly remind you why ETFs are the ideal first investment. Instant diversification. One purchase gives you exposure to hundreds of companies. Low minimum. You can start with as little as $50 in most cases. Lowest fees of any investment vehicle at often 0.03%. Easy to buy. They trade exactly like regular stocks. And flexible trading during all market hours. If you could only start with one investment type, ETFs are the answer. Now, let's buy one. Step 1. Step 1. Choose your broker. Your brokerage is the platform where you'll open your investment account, deposit money, and place your ETF orders. For beginners in the United States, I recommend starting with either Fidelity or Schwab. Here's why. Both have $0 to open an account, 0 commission on all trades. They both have fractional shares, meaning you can invest any dollar amount rather than needing to buy whole shares, and both have excellent educational resources and customer support for beginners. Vanguard is legendary for its low-cost funds and is excellent for long-term buy-and-hold investors, but its interface is less modern. TD Ameritrade has powerful tools but can feel overwhelming when you're just starting. For international investors outside the U.S., popular options include Interactive Brokers, eToro, and Trading 212, which are available in many countries. Check what's licensed and available in your specific country. For today's walkthrough, we'll use Fidelity as our example, since it's widely considered the best starting point. Whatever broker you choose, whether in the U.S. or internationally, check for these 5 things. First, 0 or very low commission per trade. Every commission is money taken from your returns. Second, proper regulation. Your broker should be licensed by your country's financial regulator. In the US, that's FINRA and the SEC. In the UK, it's the FCA. In Nigeria, it's the SEC Nigeria. Always verify they're regulated before depositing any money. Third, fractional shares. This allows you to invest any dollar amount rather than needing to buy whole shares. Fourth, low or no account minimum to open. Fifth, a user interface you can actually navigate. Try the mobile app before committing. And importantly, avoid unregulated platforms, brokers charging high commission per trade, and platforms with known withdrawal issues. Your money's safety comes first. Step 2. Open your account. This takes between 10 and 20 minutes and is done entirely online. Here's the process. Visit your chosen broker's website and click on Open Account. You'll select an individual brokerage account, which is the standard account type for most investors. Next, enter your personal information, name, address, date of birth, and your tax identification number, which is your social security number in the US or your equivalent in other countries. You'll answer some suitability questions about your investment experience, goals, and risk tolerance. Be honest here. This isn't a test. It helps the broker understand your profile. Then verify your identity, usually through email and sometimes by uploading a government ID. Most accounts are approved instantly or within 1 to 3 business days. What you'll need ready: a government-issued ID, your tax ID number, bank account details for funding, your email address, and your physical address. Get these ready before you start, and the whole process is smooth and fast. You'll be asked which type of account to open. Here's the simple guidance. For your very first account, open an individual brokerage account. This is the most flexible option, with no contribution limits, no restrictions on when you can access your money, and open to anyone. You will pay capital gains taxes when you sell at a profit, but this is standard and manageable. The second account type worth knowing is a Roth IRA. This is a retirement account where your money grows completely tax-free. You contribute after-tax dollars today, and when you withdraw in retirement, you pay zero taxes on all the growth. It has a contribution limit of $7,000 per year in 2026 and income limits. This is so powerful that I'll dedicate an entire video to it. For right now, start with the individual brokerage account and get your first ETF purchased. We'll optimize with a Roth IRA in a future video. Step 3. Fund your account. This is where you transfer money from your bank account into your brokerage account. The most common method is an ACH bank transfer, which is a free electronic transfer directly from your checking or savings account. Simply link your bank account, enter the amount you want to transfer, and confirm. The money usually arrives within 1 to 3 business days. Wire transfers are faster, sometimes same day, but usually carry a $15 to $30 fee. For most people starting out, a regular ACH transfer is perfect. Now, how much should you start with? The honest answer is, as much as you're comfortable with. $50 to $100 is a completely valid starting point. $500 to $1,000 is a solid foundation. $2,000 or more gives you more flexibility to diversify. But here's the most important thing. The amount matters far less than starting consistently. Even $50 per month invested consistently over decades becomes significant wealth through compound interest. Don't wait until you have the perfect amount. Start with what you have and add to it regularly. Step 4. Choose your ETF. For your first purchase, keep it simple. Here are 5 excellent options. VOO, Vanguard's S&P 500 ETF, tracks the 500 largest U.S. companies with an ultra-low fee of 0.03%. This is one of the most recommended first ETFs in the world. SPY from State Street does the same thing with the most liquidity of any ETF globally. VTI from Vanguard tracks all U.S. stocks, over 4,000 companies, for even broader diversification at the same 0.03% fee. SCHD from Schwab is the best dividend-focused ETF if income is your priority, with about 3.5% yield at a very low fee. And QQQ from Invesco focuses on the top 100 NASDAQ companies, heavily weighted toward tech. For your very first ETF purchase, I recommend either VOO or VTI. Both are from the trusted Vanguard family, have ultra-low fees, track hundreds of companies, and have strong long-term track records. Start here. You can always add more ETFs as your portfolio grows. Before buying any ETF, even one I've recommended, take 5 minutes to check 5 things. First, the expense ratio. Look for under 0.2%. 0.03 to 0.09 is excellent. Second, what's inside it? Check the top holdings. Are these companies you believe in and understand? You can find this on the ETF's official page or on ETF.com. Third, AUM, which stands for Assets Under Management. Look for at least $1 billion. Larger AUM means the ETF is more liquid and stable. Very small ETFs can close down. Fourth, the track record. How long has the ETF existed? 5 or more years gives you confidence it's established. Fifth, the index it tracks. Make sure you understand whether it's tracking the S&P 500, the total U.S. market, NASDAQ, or something else. For free research, ETF.com is the most comprehensive database. Yahoo Finance, Morningstar, and your brokerage's own ETF pages are also excellent. 5 minutes of research before your first purchase is a great habit to build. Step 5. Place your first order. This is the moment. Here's exactly what to do.
Open your brokerage app or website and search for the ETF ticker you've chosen, for example, VOO. Click on the ETF to open its trading screen, then click the Buy button. You'll see an order form with a few important fields. First, order type. For ETFs like VOO, VTI, SPY, and SCHD, a market order is perfectly fine. A market order executes immediately at the current market price. A limit order allows you to set a maximum price you're willing to pay, but it only executes if the price reaches that level. For popular, highly liquid ETFs, the difference between your limit price and the market price is usually just a few cents, so a market order is the right choice for beginners. Second, quantity. You can enter either the number of shares or a specific dollar amount. I recommend entering a dollar amount, like $500, because most brokerages with fractional shares will then automatically calculate the exact number of shares. Third, review the estimated cost. Make sure it matches what you expect, then click Preview Order. You'll see a summary of everything before anything is final. Review it carefully, then confirm. The preview order screen shows you everything before anything happens. You see Buy VOO, Market Order, 1.104 fractional shares, estimated total $500. Commission, $0. Everything looks right. Take a deep breath and click Confirm. And just like that, you own your first ETF. You'll see a confirmation screen and usually receive a confirmation email within minutes. Your portfolio will update showing you now own shares of VOO. Congratulations, you are officially an ETF investor. This moment, this first purchase is the most important step. Everything after this is building on what you just did.
Step 6 is where the real wealth building begins, setting up automatic investing. Most brokerages offer an automatic investment or recurring investment feature. Here's how to set it up. Go to your brokerage settings or your ETF's trading page and look for automatic investment, recurring investment, or auto invest. Select your ETF, enter your monthly amount, choose your frequency, I recommend monthly to match your pay cycle, and link it to your bank account. Click Activate. That's it. Now, every single month, on the date you specified, your brokerage automatically purchases more shares of your chosen ETF. You don't have to remember, you don't have to time the market, you don't have to fight your emotions when the market dips. It just happens. This is the dollar cost averaging strategy we covered in video 6, put on autopilot. You're automatically buying more shares when prices are low and fewer when prices are high, averaging out your cost over time. This single setup, taking about 3 minutes, puts your entire wealth building process on autopilot. Most serious long-term investors use this method because it removes the biggest obstacle in investing, human emotion and inconsistency. How much should you set for your automatic investment? Here's a practical guide by income level. If you're starting out or a student, even $25 to $50 per month is a meaningful start. Over 30 years, $50 per month becomes over $113,000 at 10% average return. At $2,000 to $3,000 per month income, target $100 to $200 invested monthly, about 5 to 10% of your income. At $3,000 to $5,000 per month, $200 to $400 monthly. $5,000 to $8,000 per month, $500 to $800 monthly. And above $8,000 per month, start at $1,000 or more. The general rule is to auto-invest 10 to 20% of your monthly income. As your income grows, increase the amount. Never decrease it unless it's a genuine financial emergency. The power isn't in the starting amount. The power is in the consistency. Every income level can build meaningful wealth. Start where you are. Step 7, your final setup, turn on DRIP, which stands for Dividend Reinvestment Plan. Even index ETFs like VOO pay small dividends quarterly. Without DRIP, those dividends sit in your account as cash, doing nothing. With DRIP turned on, every dividend payment is automatically used to purchase more shares of the same ETF. Those new shares then generate more dividends. Those dividends buy more shares. It's compound interest working through dividends. To turn it on, go to your brokerage settings, look for dividends, reinvestment options, or DRIP settings.
Toggle it on for your ETF. It's usually one click. And the difference it makes? Using SCHD as an example, $500 a month for 10 years without DRIP grows to about $87,000. The same investment with DRIP, $108,000, $21,000 more from one toggle switch. After completing Step 7, your entire ETF investment system is set up and running on autopilot. Monthly automatic investments happening, dividends automatically reinvesting, compound interest working around the clock. Before we wrap up, here are 5 mistakes to actively avoid after buying your first ETF. 1. Checking your portfolio daily. The market moves up and down every single day. Daily checking creates anxiety and leads to emotional decisions. Check monthly at most. 2. Panic selling during market dips. Every single market in history has had corrections and crashes. Every single one has eventually recovered and gone higher. During a dip, your automatic investments are buying more shares at lower prices. Panic selling locks in losses. Do nothing and keep investing. 3. Over-diversifying too early. Owning 20 different ETFs when you're starting out actually doesn't help as much as you think. Many ETFs hold the same stocks. Start with 1 to 3 ETFs and only add when you genuinely understand what you're adding. 4. Stopping your automatic investments when the market drops. This is the single worst thing you can do. Market drops mean you're getting more shares for the same amount. Keep going. And 5. Chasing last year's performance. The best performing ETF of last year is rarely the best this year. Stick to your low-cost, broad market strategy and let time do the work. Let's bring it all together. Your complete 7-step ETF buying checklist. Step 1. Choose your broker. Fidelity or Schwab for U.S. investors. Check local options internationally. Step 2. Open your individual brokerage account. Takes 10 to 20 minutes. Step 3. Fund it with whatever amount you're comfortable starting with via ACH bank transfer. Step 4. Choose your ETF, VOO or VTI for most beginners. Step 5. Place a market order, preview it, and confirm. Step 6. Set up automatic monthly investing at 10 to 20% of your income. Step 7. Turn on DRIP in settings. Total time, about 30 minutes. And what have you set in motion? If you auto-invest $200 a month and let compound interest and DRIP work for 30 years, you're looking at over $678,000. These 30 minutes you're going to spend today, they're possibly the most financially important 30 minutes of your life. Go do it. Right now. Today. Not next week. Today. If this step-by-step guide helped you finally take action on your first ETF purchase, please hit that subscribe button and turn on notifications right now. Every week on the Investing Whiteboard, I break down investing concepts this simply using real experience from over a decade in the markets. In my next video, I'm covering what Bitcoin is and why people invest in it, using my 9 years of personal crypto experience to break it down as simply as everything else we've covered. It's going to be really exciting. Drop a comment below and tell me, which broker are you planning to use? Or if you've already bought your first ETF after watching this video, tell me which one you bought. Those comments are the most motivating things in the world, and I genuinely read every single one. Thanks for watching. Remember, the best investment you'll ever make is the one you actually make. 30 minutes today, decades of wealth building tomorrow. Go do it. See you in the next one.